Vice Provost for Graduate Student Development and Postdoctoral Affairs here at UMBC, and I'm also the Director of the Promise AGET program for the University System of Maryland. And today we have the great opportunity to have a speaker, the Executive Vice President for the Consumer Credit Counseling Service of Maryland and Delaware, Lori Jankalski. And she has volunteered her time to come and share with us about credit reports and credit scores. Some of you know that we have a grant here at UMBC, part of the Council of Graduate Schools, enhancing student financial literacy. And so we're trying to make sure that all of our graduate students and also our student community have the information that you need so that you can have financially sound futures. So at this point, as people are getting their seats, we're going to let Lori Jankalski come on up to the front, and she's just going to go ahead and take it from there. Any of people who have questions online, I think there might be an opportunity, a mechanism to put some questions online. And for those of you who are here, you have the benefit of having the speaker to yourself in person. So please, let's welcome Lori Jankalski.
And if you don't mind, we're going to kind of hold questions to the end, because I know some people have classes to go to, and sometimes you can get caught up in so many in the middle, I don't get through the whole thing. So thank you for having me. I'm going to also thank Renata. One of the reasons why, that, like I said, Consumer Credit Counseling Service, people, a lot of times are not familiar with what type of work and things that we do. But we are a nonprofit financial counseling agency. So usually we're working with individuals that have run into some financial issues for a variety of reasons. And many times, sometimes the reason that they're seeking their help is because they really didn't have a good handle on some of the documents, things they were signing, some of the debt that they were taking on. So like I said, we work with them as an intermediary between them and their creditors to help work out some financial arrangements for them and the other concessions. One of the reasons why I'm here talking to you today about the credit reports and credit scores is because my first career, I retired from Equifax, credit reporting agency, after 10 years. So that was my line of work. It's what I did for 40 years, and then I didn't really like retirement, so I went back to work for a few years. And this is what I'm doing now, trying to educate people. Okay. Again, this is just Consumer Credit Counseling Service. Our mission is to promote the financial literacy within the community, and we do that by means of financial counseling with individuals, and then also through workshops and education. Yeah, understanding credit reports and credit scores, and this is a very, very good topic, because no matter what field that you want to go into in terms of your work career, the credit report, credit scores affect you no matter what line that you're in. Now, a lot of people want to know what kind of information shows up on their credit report. So first off, the type of information is just your ID information, identification. Identification information shows up on the credit report, as well as any employment information. The identification is really just to make your positive ID. So when you're filling out a credit card application or a car loan, whatever it may be, as unique as you think you may have his last name, there's somebody else in this country with that same name, I guarantee you. Payment history. So anyone who has already established credit for you, whether it was a Macy's department store account or Ford Motor Credit gave you a car loan, that information will be reported on the credit report, and it will say when you opened the account, what was the amount of credit that they issued to you? Was it a credit line for $5,000? Was it a car loan for $20,000? Whatever it may be. They will also list on there your account number, your balance on the account, and then your payment history for a full 7 years. So month to month, you could have made every single payment and on time until this past June. And for some reason, you missed a payment on vacation, have a good time. That statement that you missed a payment in June of 2014 will remain on your credit file for 7 years. Public record information. Public records would be anything that is filed with the courts that would affect how you actually pay on your bills. So it will be information if someone had to, for instance, sue you to get payment on your Macy's account, or if you ever filed bankruptcy. So information pertaining to, for instance, any kind of driving offenses, any kind of criminal record, public record information is not going to show in your credit report. Inquiries. Inquiry would be a listing of any place that you have applied for credit. Now, one of the reasons why we mentioned that is because there's two different types of inquiries. The first is considered a hard pull inquiry, and that is where you have initiated the transaction. You filled out the credit card application, or you filled out for the application at the rental office in an apartment complex. You've initiated it. That inquiry will stay on your credit report for 2 years. And any inquiry that you have initiated is used to calculate your credit score. Now, there's another type of an inquiry, and it's considered a soft pull inquiry. And that means where a credit grantor has solicited you. You've got something in the mail that says you've been pre-approved for your $5,000 MasterCard, or it could even be something to the effect you've been pre-approved for car insurance through Geico. Any type of that type of thing where they are soliciting you to do business with them, it still has to be posted to your credit report, because again, that's going to have a complete audit trail of anyone who's ever looked at your credit file, including if you look at it yourself. But it is not used to calculate your credit score, because again, the vast majority of people who get those type of offers, that 98.5% of people just trash them. So, but again, the credit grantor, the insurance company, whoever it may be, they did actually review your credit file. The reason why inquiries are so important is because statistically, 6 inquiries on your credit report, remember, they can only stay for 2 years, 6 inquiries on your credit report at any one given point in time, those individuals are 8 times more likely to file bankruptcy. That's why credit granors pay so much attention to that kind of information. Give you an example of how that happens, because people say, well, that's not a lot. If you really need credit, that's fine. You do need to apply for it. But what happens in many cases, Veterans Day, just a week or so ago, a lot of malls, when there's a holiday coming up, they want to do a big promotion. They want to try to get everybody in to go shopping. So as part of that, most of the retailers within a mall may have a program where they're going to offer special discounts if you fill out one of their credit card applications. And I'm sure everyone's been at that cash register at some point in time, and they've said, would you like to open up a Kohl's Charge, have it at JCPenney's, MasterCard, whoever it may be. And if they say, because if you open it today, you'll get 10 or 15% off all your purchases today. So some people say, oh yeah, that's great. Well, if you go through a mall and you fill out 6 or 7 applications in one day, you just tanked your credit score. Within 2 years, okay? So that's why I said, so you have to be careful, because if you're doing it strictly to get a little discount on that day's purchases, like I said, your credit score can go down dramatically. Now, information that's on your credit report, this is how long the information stays. And this is regulated by the Federal Trade Commission and now by the Consumer Financial Protection Bureau. But this is how long it's regulated. And this is a federal regulation. Most states have their own separate regulations. So federal always takes precedent unless the state is more favorable to the consumer. 7 years is pretty much the rule of thumb. So if you've had any kind of delinquency on an account that you opened, if it's ever gone to a collection agency, an account has ever been charged off, anyone's ever had repossession, the information is going to stay on your credit file for 7 years from the date of your last payment. Not from when you open the account originally, because some people, you may have an account open for 30 years when you get to be that old. Okay. One of the things that is the exception is anything that you owe to the federal government, state government, city, county government. So student loans and also tax liens, they will remain on your credit file until they are paid. And then once they are paid, the 7-year timeline kicks in, and it'll start from the last date that you paid it. Bankruptcy. Bankruptcy is the other exception, and there's 2 types of bankruptcies that an individual can file. And the courts determine which bankruptcy you're allowed to file. They do a means test, and if you file Chapter 7, that would be, usually you have just sufficient enough income to basically live, not enough to repay any debts. You also do not own any property. You also would have a vehicle worth at least $6,500 or less. Then you are allowed to file Chapter 7 bankruptcy, which means the court deems you do not have the ability to pay back your creditors, and they wipe out all your debts. Now, when that happens, you're also not going to get any new credit for a long time. Because what they said is basically, whatever the circumstances, credit was extended to you, you ran the circumstances, you were unable to return or make those payments, creditors took a loss, other creditors are very hesitant to give you a second chance. The second would be in Chapter 13, excuse me, and this would be a bankruptcy where, again, based on the means test, usually what happens is you make more than just the minimum to be able to live. You usually, most times it's a homeowner that has some equity in their home and they want to keep the home. And they have a vehicle or two vehicles that are worth more than the $6,500. And those individuals, the courts determine, you do not have the ability to pay all of your creditors back 100%, but they will possibly come up with a formula that says you need to pay 30 cents back on the dollar. And then they will set you up with a payment plan that you pay directly to the courts, and the courts disperse it to your creditors. And again, it's always a 60-month plan, and if you do not make payments anytime during that 60 months, then they throw the bankruptcy out. The creditors can come back after you, give you 100 cents back on the dollar. So it's a plan that you've got to take very seriously. Now, what we normally suggest is for everyone to get a copy of their credit report. And this is the actual site that the government set up. It's mandated. This is the one where it really is a free credit report as opposed to freecreditreport.com with cute tables and stuff, or Credit Karma and all those places. They're ultimately trying to sell you something. This particular one, like I said, it's a joint venture between the three major credit reporting entities, which would be Equifax, Experian, and TransUnion. So when you go to this one site, you can get all three of your credit reports. Initially, we do tell you, if you've never looked at the credit file, you really should pull all three at one time, review it so that if there's any kind of discrepancies, you can act on it to get them straightened down. After that, following years, we usually say just spot check them. So maybe pull an Equifax in April, and pull in July, or time frame would be, pull Experian, and October pull TransUnion, so you can just spot check them to see, make sure everything is still accurate. But again, one per year, and some of the literature we have has got the same information in there where it's telling you where what the website is. Once you get a copy of your credit report, if there is anything on your file that is an error or something that you disagree with, whatever it is, it'll give you a whole process of what you need to do to try to dispute the information and get it straightened out. Now, credit scores, because a lot of people are saying, we hear a lot more about credit scores, and they're saying, well, I don't really care about my credit report, I just want my credit score. Well, you can't get one without the other. The credit report itself is owned by those three previous credit reporting agencies, Equifax, Experian, and TransUnion. The credit score is literally a model, mathematical model, that is applied to that file. The model is owned by another company. It's called FICO. They're a Mexican company, and the government did not mandate that they give away a score. So when you go in to get your credit report, you'll get just your credit report. It will give you the option, if you want to buy the credit score, you can, but the credit reporting agencies can't give it to you because they don't own it. So, like I said, this is what the credit score is. We're using FICO because that is the main credit score that's used probably 95% of any of the transactions that take place within the credit rating community. There's models for everything though. There's a model that will tell credit card companies who's going to charge and pay off in full every month. There's models that will tell them if you've gone delinquent, what's the probability that you will pay at some point in time, as opposed to never paying. So there's really all kinds of different models. But like I said, it's just strictly a complex mathematical model. And at FICO, they literally, that whole company is nothing but statisticians. That's what they do. The credit score model has to be revalidated every 2 years so that it can prove that it's statistically sound, empirically derived, and it stands up in court, so that there is no discrimination when someone's approving or denying credit, or assigning credit limits, or assigning interest rate limits. So like I said, that's basically all that company does. They also do the scorecards like an IRS that determines who's going to get audited. It's literally a random thing that goes through. They say, okay, this year we're going to use scorecard number 3. Anybody that matches up to scorecard number 3 gets an audit. And they just rotate it. Credit score is used by a lender to help them determine who gets approved, who gets denied. And also, like you'll see later on, it'll help them decide not only do you get approved, but at what interest rate, what credit limit.
I have a question, and this is general actually, but it's related. what is worse, bad credit or not credit?
They're about equally the same, and I'll tell you why. Bad credit means at some point in time, again, this isn't always, that you've had credit extended to you, and then you ran into problems. Now, with some people, the problem is they just had a good time charging and couldn't live within their means. And that's the one where most people don't have any sympathy for. But there's a lot of cases where people have had serious medical illnesses in a family, and they've just been overwhelmed with the medical bills. Could also be, especially in this latest economy since 2008-9, there were a lot of people who were laid off that were long-term unemployment, 2 and 3 years before they could get anything coming in. So, if that's the case, you can obviously go through all your savings. People tapped into their retirements, and many of them were surviving on their credit cards. But it got to the point, once they maxed everything out, they just, there just wasn't enough money to pay it. So, many times you have to readdress that before you can get reestablished. When I say no credit can also be bad, it depends. If people are 20, 21 years old, 22 and stuff, credit granted don't expect you to have a lot of credit. So when you don't have any at that point, that makes sense. If you're 40 and you have no credit, what a credit grantor automatically assumes is you're altering your ID enough. You probably had credit, it was bad, and you're altering your ID enough to, a no record in that instance would be better than bad credit. So what we find in many cases would be parents using their children's social security numbers or birthdays, that kind of stuff like that. So there's a few things that the credit reporting agencies offer to help alert to that, but it's possible with enough information for someone to do that. So, but like I said, in this society, by 40, people have had credit. Okay. The only other situation they're thinking, if you really didn't have any credit, then you've been in prison. If you didn't like your ID.
Yes. And that's why I'm asking, because actually in US it's really.
Oh, yeah, as opposed to most of these credit reporting agencies, they operate in other continents and stuff too. But the US uses credit so much more extensively than any other country. It's a whole, it is just completely different. Exactly. Most of Europe, you kind of put into one category of how they use it, which is different. And then, like I said, you get into Middle East countries and like India and things like that. They're just really starting out on the credit system and things. But the U.S., the whole thing is built on credit, which is one of the reasons why the economy is so sluggish right now. People are afraid to make debt. Credit granors have tightened up. They're not giving it out, so everything's kind of just slowed down. Now, one of the other things is, like I said, when you're using the credit score, it is determining the risk that that company is willing to take by extending the credit. So it's important to know every individual company, credit grantor, determines how much risk they're willing to take. So it's possible you can fill out an application today, same credit report, and you fill out an application, say with Bank of America, and you fill one out Chase Bank. Bank of America could approve you and Chase could turn you down. It's their own internal policies, how much risk and things that they're willing to take. And again, going back in the previous few years, with a lot of the mortgage foreclosures and things, banks were taking huge losses, so they have really tightened up credit dramatically. So they're a lot less willing to extend the amount of credit limits that they previously gave, as well as they've tightened up so much more, many more people don't meet their criteria and are turned down right now. But again, they're starting to loosen up some. The other advantage to a credit score is, previous to credit scores, an individual company would spend 2 and 3 years training a person to become a credit analyst, to be able to evaluate a credit report, to be able to do the research and the checking that was necessary to make a credit decision and whether to approve them or decline them. One of the things that credit scoring did was it made it instantaneous. Once companies studied it, they realized what the risk, they could do it. It made it instantaneous, which has helped with credit, so that you can go out, 9 o'clock at night and buy a car and have it financed. I guarantee you, there's nobody sitting at the bank approving that credit though. They know what their criteria is, so they automatically put you in the car and send you down the road with it. The other thing is, credit scores also took out of the equation in any individual's personal bias. Because this way, there is no making a decision because you live in this zip code, or because you are this age, or because you are of this nationality. It doesn't care. That information isn't used, and it's not on the credit report. So that's why it's very nice and clean and fast. They can hire people, get them quite trained much quicker, and it's not as much of an investment on the bank, financial institution, or the retailers to put and invest in someone to get someone who can be productive and good at their job. Now, the credit score, okay, what is my score? Because everyone wants to know that. First off, understand it could change daily. There is no number sitting out there assigned to your credit file. Each time when you apply for credit, your credit report is pulled, think like a file cabinet, it's pulled, and at that moment, it gets run through the scorecard. Because last night, you could have had something derogatory. You didn't pay your Sears bill from 7 years ago, and it was really tanking your credit score because it said you were so delinquent. But the 7 years was up, and last night it purged off your credit file. Today, you look good, so you have a better credit score than you did yesterday, or vice versa. Right today, your credit file says you paid everybody on time, you always have, never been delinquent, but tonight, somebody reports that you didn't make your November payment to them, and your credit score goes down. So that's why it can change possibly daily. There's 3 credit reporting agencies, and each of them could have a different credit score on it. And the reason being, if it's a national company, Bank of America, Chase, Capital One, JCPenney's, Macy's and stuff, they're going to report information to all 3 of the credit reporting agencies. So that information should be the same. What would make the scores different would be in an individual market, like say Baltimore, for instance, State Employees Credit Union only reports to Equifax. The reason being, 99% of their members live in Maryland. They only use Equifax and full credit reports. There's an expense for them to report the data to each of the 3 credit reporting agencies. So they said, we only use Equifax, we're only going to give it to them. So that information would be missing from your Experian and your TransUnion, and vice versa, different parts of the country. In addition, credit grantors pay to pull a credit report. So, and at any given time, when you're doing a transaction and you filled out an application at H&M clothing store, they're only going to pull 1 credit report. So your inquiry, remember that's used to calculate your credit score because you initiated that transaction, is only going to be on 1 of the credit files. The exception would be for like a mortgage. Because of the expense and how long-term that is, in that instances, they'll pull all 3 credit reporting agencies. Again, the score is identifying how much risk the financial institution or the retailer is taking when they approve you or deny you. Okay? So it's for their benefit. Now, this is just a general score distribution. This is for the whole country, 300 million files, whatever. And we've broken it into kind of scoring ranges. The lowest score on a FICO credit score goes to 300. Yes, ma'am.
Sorry, so I was just thinking, if different companies or whatever report to different agencies, is it possible that you don't have a score with one then?
Only if the only thing that can't be scored would be if for instance, once you file bankruptcy, then your file won't be scored. If you only have 1 account on your file, there needs to be information that would have from 2 different sources. So even if you had an inquiry from Sears, for some reason the account's not open, but yet you have an account listed on there who opened credit with you at, say, Capital One, you could still get a score. Okay. So all the accounts have to be open at least 6 months, at least from 2 different sources. Nothing can be disputed on your credit report. You can't have a bankruptcy. Any indication somebody's deceased, the file won't be scored. Okay. So with this one, like I said, the low score will be about 300 and low is bad, high is good, and it goes up to about 850. Yes.
There is another person watching it online, so she asked me to ask.
Sure.
So she was asking that, do you have to pay a fee to check your credit score?
Good question. No, you don't.
Okay.
Everyone's entitled to 1 free copy of their credit report per year, and that's from each of the entities. And then if you want to check it every month, then they will charge you a fee. And it's usually like $4.95. Okay. But most times, once a year is fine. And then that's why we mentioned the second year, if you've got the first time, if there were any issues you have them straightened out. The second time, we're saying maybe spot check it, maybe 1 every 4 months between the 3 places. That's a good question.
And then she has another question.
Okay.
Too. So if she does ask for a credit score, does it lower down your credit score by
No.
asking?
Very good. The soft inquiries, the ones where the companies are soliciting you, or if you look at your own credit report, they're all considered soft inquiries. They're not used in calculating the score at all.
Okay.
That's not a good question.
I think the first question was credit score, not credit report. Do
Credit
you have
score.
to pay for that?
The credit score, you do have to pay for, but not the credit report, because they come separate.
Okay.
And you can't get the score without the report, so you can't get just the score, but you can get the report without the score.
Is it a federal agency, the credit report?
No. Private company, Equifax is listed on the New York Stock Exchange. TransUnion is a privately held entity. Same people that own like the Hyatt Hotels owns TransUnion, and Experian is actually a UK company.
So there are some websites like Credit Karma. They also calculate your credit scores. So how reliable are they? And
They are good, but they don't deliver the FICO score, which is the most commonly one used. But the score they do deliver is calibrated to meet the same ranges as the FICO score. The thing with Credit Karma though is, and that's actually run by TransUnion, that site. You don't pay for the credit report or the score on that website, but if you have a good credit score, what they will ask, I don't know if you've ever tried it, but once you've gone in there, and if you have a good credit score, you will be offered what you qualify for, and that's who's paying for it, whoever is soliciting you. That would be, again, be a soft inquiry, but that's what they're doing. That's actually, they're trying to get new accounts and stuff like that. Some people, you'll see 4 or 5 offers listed. You know, you qualify for this MasterCard or this Visa or whatever it is. The annual credit report.COMM is actually the one offered by the individual credit reporting agencies, and it's a mandated site by the government, and they can't sell you the credit report. They just cannot.
Question. Is it true that when you close a credit card, even if it's in zeros, did it affect your credit score?
It could. Let me get to that in another minute. Because that's a good question, because some people will do that and it can actually hurt themselves.
You said that people with 6 inquiries or more and the credit reports are 8 times more likely to claim bankruptcy. So the other people soliciting you count towards that?
No, because that would fall into the soft inquiries, and they're not counted at all. And that's why we want to make that distinction, because when credit is a little bit more looser, and the economy's starting to get a little bit better, because I know I'm starting to get them in my mailbox now. Southwest wants me to take their credit card so bad. I'm going to get 3 offers of those a week. And then that's credit card. So, and I don't need anyone, so I'm shredding them and getting rid of them. But if they didn't, some of those folks have like good credit. They would never be able to get credit again, because as the economy loosens up a little bit, they're getting 3 and 4 offers a week from different places. Yeah. But you can see here with the score ranges, and we just lumped anyone that's 499 and below. Remember, it starts at 300, low score band. They're not going to get credit. They're at the bottom end of it. I don't care who they apply to. Those are the individuals that would go someplace like a payday lender, which, yeah, there are a lot on the internet. Locally, I think, who they target this market, because like Montel Williams, because he's originally from Baltimore, they target this market. You're paying 300 to like 700% interest for that stuff. You can never get out from under those things, so don't. They're technically illegal in Maryland, but if you do it on the internet, you know, there's no storefront for them to shut down.
You mentioned Credit Karma. Do they provide FICO scores or?
No, they're providing their own score, but they do have it calibrated to the same. So we'll give you a range there. Yeah, at the very high end, you're 800 and above. Again, that's a good score, but what usually falls into that are seriously older individuals where they've had all their credit. They're not really actively applying for anything else. They probably have no inquiries on their file. You know, all their credit cards have been open for 30 years and never delinquent or anything like that. Companies, they're fine, but companies don't solicit that kind of individual either, because they're not looking for new credit, and if they wanted to, they have their pick, they can go anywhere they want. So when you get down into the lower ranges, no one is soliciting them either. But the bulk of the population, you can see, are in the mid ranges. Depends on the time of the economy. So right now, currently, with the environment that we're in right now, if you have a score of like 620 and below, you're not getting credit. There's just not. Previous to 2008, when the foreclosure stuff really started hitting, they were giving out mortgages to people at 500 scores. And those were the ones who lost their houses. They had no track record. There was no doc loans. They just made up their incomes. They were in a nice house for a year before they got put out. Okay, that's not everybody, because as time went on, unemployment went into effect, and then you had people who really were living within their means. They could afford their home. They just lost their jobs and couldn't afford to make payments. But like I said, right now, most credit card companies are looking at a score about 700. Mortgages, depending on the product and stuff, you can start getting them about 640 score. It's like an FHA or a VA loan, something like that. If you're going to a conventional, they're back into the 700 ranges and stuff because they usually hold the paper. So like I said, but in the credit card ranges, usually you're in the 700s and stuff. Now the difference would be at 700, for instance, you get approved, and you try to get maybe, I'll give you an example, a $2,000 credit line, and you might get charged an interest rate of 24.9. Okay? So if you get, I'm just saying 750, you're still going to get approved, but you're going to get a credit line of maybe $5,000, and your interest rate might be 21.9. And if you go a little higher yet, you're at 780, you probably get a $10,000 line of credit, possibly 14.9% interest rate. So you can see everyone's approved, but it's how much of the risk they're willing to take. So they're saying, okay, we're approving you, but you're going to pay 24.9 and a lower limit until they kind of learn, see how you handle the account, give you some history on the account. So now, what makes up the credit score? 35% of it is your payment history. So that, to an extent, is in your control. I always say that because you don't want to shoot yourself in the foot. And I'll give you an example. And this happens more to younger people. When a credit card company gives you the account and you find out your due date is the 15th of the month, that's not a suggestion. They really want the payment on the 15th. Okay? And I only say that because they can't report you delinquent to a credit reporting agency until you're a full 30 days past due. But most of them have a cutoff at like 7 p.m. Eastern time on the date, like say the 15th, when your payment's due. If it comes in at 8 o'clock, you're late in their book. They can charge you a late fee, usually $39. And the first time, not too big. But if you're doing it like every other month, or even, 4 times a year, eventually they can up your interest rate on you. And many times if you had a pretty good rate, I don't know, 14.9, 18.9, they can take you to the max of 29.99. The difference in your minimum payment, because that can go back onto all your purchases that you're carrying a balance on. And so that's why it's important to make the payments on time.
There's an urban legend that if you pay the total of what you expend in your credit card, just like in once,
yes,
like a debit card pretty much, that it's not so good for your credit score.
Nope, totally false. The way it works is, number one, in fact, you're better off if you can do that. As long as you make your minimum payment, if it's $25, whatever it may be, and you get it there on the due date, that's the same in terms of the credit card company, the way they're looking at it, and how it would affect your credit report. It's the same as if you paid the entire balance off each month. You're paying according to the terms of the agreement that you signed, whether it's the minimum payment or you paid it in full. Now, you're best to pay it in full if you can, or to put as much as you can on it, because the interest continues to be charged on the balance. And you know what happens from the very first time you start carrying that balance, the interest got applied to it. The next month, you're paying interest on interest in addition to the principal. So you're better off if you possibly can. But that, I'm not sure exactly where that started. Every time I talk to a group, somebody has that question.
Yes, it's an urban legend.
Well, we're told if we pay it off, we're not really building a credit history. Nope. As long as you make the minimum payment, it's the same as if you paid it, whole thing off in full each month. Yes, sir.
What about diversity of credit, like car loan, credit cards, stuff like that?
Types of credit, new credit. That's exactly what that is. They're looking to see, a credit card company is looking to see if you have 10 items of credit on your credit report and they're all credit cards, you're not gonna have as good a score as if you have had a car loan, as if somebody has, if somebody's renting you an apartment, as long as there's a mix of it. Because credit cards, remember, is what they call unsecured debt. If you don't pay them, there's nothing they can do except cut off the credit card. They can't come back and repossess last week's dinner, or take the dress or whatever it is. You got a car, a motorcycle, a boat, they come and get the merchandise if you haven't made your payment, okay? So with unsecured credit, that's why credit granted are usually a little bit tighter, more selective, careful with who they're giving credit to. They don't want to be the first account that you're going to get. They want to see you go get one at H&M clothing stores or, something at Zales Jeweler store for, $200 watch or something that you bought and made a few payments. They want to eventually try it out on somebody else before you have their credit card that they can use anywhere.
So back to the example that you were talking about, many of these federal employees using their jobs, and they defaulted on their credit cards. Once they paid it off, it being like a year or 2 years after
Should have.
Yeah. How does that affect their credit? Like, not how does it affect it, but what happens if once they pay it off? Is there like a section on your credit report saying, yeah, they defaulted because of no income?
No. There can be, but most times there's not. What happens is, and that's one of the things we covered, that if you get to the point where you have a bill that's due the end of this month, and it's up, and your payment's $100, but you went into work today and they sent you back home and they said, we're laying off, I'm sorry, it's your last day, go. The first thing you need to do, especially if you can file for unemployment, but the next thing you need to do is go home and work up kind of like a crisis budget to find out, okay, because you gotta pay what you have to pay, pays to live, food, utilities, whatever, that kind of stuff. And in the hierarchy of how you pay, normally then it's like your installment loans, your car loans, if you have a mortgage, that kind of stuff. What falls to the bottom usually are credit cards. Doctors actually fall below that, to doctor's bills and things like that. So what you need to do then is work out a crisis budget, and if whoever it is you owe that $100 a month payment to this month, you need to get on the phone and let them know right away. Listen, I lost my job, I do everything I can, I need you to work with me, but you need to know how much you can afford to pay. They're not just gonna say, forget it, don't send me anything this month. That's never gonna come out in any creditor's mouth. Their first person you talk to is gonna tell you, too bad, you owe me $100, you need to pay me. You're gonna have to usually escalate it to the next person, their manager, whoever that may be. And when you're doing this, you need to be documenting everything, the date, the time, who you're talking to, what their phone number is, what they said, what you said, those kind of stuff. And many times they'll say something like, okay, we'll work with you. And because you've determined, I can send you $25. I can't give you the 100, I can do 25, work with me. Most times they will agree. Now they're going to continue to accrue interest. And in most cases, it's going to show that you're past due because a partial payment still doesn't count as a payment. Okay? But they'll work with you. Most times what they're going to say is, we'll say late this month, next month, and then we want to talk to you again and see what are your prospects. Have you got another job? Can you borrow money from family? That kind of stuff. You need to be proactive and work with them. As long as you keep it from collection agencies, going to attorneys, because you're picking up all those additional costs attached to your delinquency. So that's why I say you need to have that. Credit, as an individual, you can put a personal statement on your credit report that states, such and such a date I lost my job. You're limited to 100 words, because before they did that, people would write War and Peace, explain their situation. So it's limited to 100 words, and your credit file cannot be given out unless that statement's given each time. And many times the credit grantor can really validate that, because once they get experience on how to read a credit report, you can see, well, this person's had credit for past 10 years, never missed a payment until this time. Looks like this matches up. They told me they went back to work at this time. They started getting caught up, so you can see that the delinquency stopped. So the delinquency will still stay there, but once you'll have it eventually paid, goes to a zero balance. All of that does help to improve your credit score, but the blemishes won't go totally away until the 7 years.
So even if you paid everything in full, like once you start working, you pay everything in full.
Right.
Your credit score still won't be.
It won't immediately go up just because you paid. It's a gradual build. The further time that elapses from when the delinquency occurred, your score gradually gets better. The FICO score, which like I said is the main one that is used within the credit screening community, that score, what it actually predicts is the probability of you going seriously delinquent within the next 24 months. And they define seriously delinquent as being a consecutive 60 days past due on any one account. So that means, you didn't pay your October payment or your November payment at Sears, full 60 days, and like I said, within 24 months. So if you have a multiple of accounts on your credit file, and if only one of them went delinquent, your score's not going to go down much, 5, 10 points. But if 2 months, 3 months later, you go delinquent on another account, and a couple months after that on another one, even if you skip a payment and you pay on the next month, a pattern starts to form, and the credit score says, okay, something's going on. They don't know what it is. Maybe you lost a job, maybe a spouse lost a job, maybe there's an illness in the family or whatever it may be, but it starts to see a pattern. And again, revolving debt initially, your score will only drop the first time, 5, 10 points, if you have enough other accounts to kind of offset it. The first time you miss like an installment loan, that's a car loan or car payment, it'll drop like 100 points. Because they know as soon as that payment's missed, Ford Motor Credit or General Motors or Toyota Motor Credit, they're out looking for the car. They're trying to get you on the phone, but they're looking for that vehicle. And depending on your credit score, I think if y'all didn't pay attention to the news a week or 2 ago, depending on your credit score, they're installing GPSs on them so they can find them. Remember the guy who kidnapped the girl in Philadelphia? Ended up with her, whatever, okay, y'all called her Maryland. He didn't have very good credit. So they, through one of the pictures, going through the toll booths and stuff, they got the dealer on the back of the car, the name. They went to the dealer, found out what he bought. He had a bad credit score. They had a GPS on it. That's how they got it. So your credit score and credit history affects you in all kind of ways. Because until it's paid for in full, it's still theirs. Okay? Now, just
Do you mind to elaborate a little bit on the amounts?
oh, I'm sorry, yes, I'm sorry. Here we go. With the amount owed, and that was a good question, because this is important. 30% of your credit score is made up basically on the amount that you totally owe. And that's, again, your credit report does not contain an income. So it's not based on like a comparison to your income. What it's based on is with revolving accounts, and again, that's your credit cards, whether it's a department store account or a credit card account or gasoline credit card, it'll add up all of the credit limits that have been extended to you. So if you have 5 accounts and each one of them gave you a $5,000 credit limit, what it's saying is if you wanted to, you could go out and charge up $25,000 worth of merchandise. It then looks at the balances. Now, if each one of your accounts, you owe $4,935, basically it's saying you're maxed out. And you're living on credit. And when it looks at it and sees multiple credit cards like that, and they're all at that almost at the very max limit, basically it's saying you're living above your means. They don't know all what's going on, but you're living on credit. So that's one of the things. So what it does a debt utilization. So if you've got 5 credit cards and they all have $5,000 credit limits, and maybe between all 5 of them you're using them, you only owe a total of $4,900. You got a good credit score because it's utilization. They're saying, okay, this person uses it, but it doesn't get out of control. They're not maxing out the accounts.
Do they look at the ratio of the amount owed relative to the amount maximum amount that you can borrow, since they're like that debt to credit
utilization?
Yeah,
that's exactly what they're looking at. Yeah. Now they won't do that, for instance. They don't take into consideration your mortgage because that's the maximum now. Just for regular credit card debt, they don't. If you're going in for like a larger installment loan, that's not quite as automated. So that's where an individual is looking at it. They might say, they got a good credit score, but look, this is what the person makes. And they're saying they've already got a $2,500 mortgage payment. They already have another vehicle. They got a $500 a month payment on. They got some credit card debt, and they're saying, gosh, I don't know, this person looks like they're already pretty loaded, by the time they figure, I need a couple hundred for utilities and things like that and groceries. They might say, you can't afford another $500 or $700 a month car payment. That's where they'll look at the whole picture. But it's just a credit card thing and they're calculating it. They're strictly looking at how much you've available credit and how much you've utilized. Now, again, this was the types of credit, I'm sorry, where we got back before, where they want to see that you've got some credit, credit cards, and you've got car loans and retail credit as opposed to, bank credit cards.
What about a case of if I get a credit card but I never use it? Would it consider a good way or not?
No, that could be good because it would have your credit limit listed with a zero balance. So it would say, okay, she's got available $5,000, but the balance is zero. No utilization, stuff like that. So that can be good. And again, that's got credit established, better than waiting till you're 40 and trying to apply for the first
So
time.
you're saying it's not necessary to get a credit card, or you have to use it?
Correct. If you can discipline yourself, that's the way to do it. Yes, sir.
But what if you had a credit card, you had a bad experience with that credit card company, but you're like, I'm not gonna close them, I just won't renew it. Is that the way to do it or no?
Well, let me tell you, that kind of ties into your question back here. Most times with a credit card company, you don't renew it. They do renew it. So if you are not interested in it, okay, and it depends. If you have just one account that you really, I just want to close it for whatever reason, the interest rate's too high, not a good experience with the customer service, whatever it may be. If you just close one account and you have other multiple accounts on your credit file and they're all good and stuff like that, that's fine. One will not do it. Where it could hurt you would be if you had, and we used to see this in cases a few years ago, I think everyone's learned now. Real estate agents sometimes would tell people when they're out buying a home, look, you got all these credit cards, we got Macy's and Penny's and all this. Let's move all the balances onto one credit card and we'll close another couple out. And that way it looks like you have one account. Well, the trouble was they closed all of them, and the one account, by the time they moved all the balances, they maxed out. It looked like they were maxed out because they owed $5,000 and the credit was $5,000. So it did the exact opposite of what they were trying to do. If you have just the one, close it, and they actually note on the file that it was closed at your request, as opposed to closed by the credit grantor's request. Because sometimes if the credit grantor's closing it, it usually means they shut you down for some reason, okay? Because they want to build their portfolio, keep doing that one. So where it could hurt you, what I was going to say, if you closed one or too many at one time, this goes back to you have 5 accounts and you have potential $25,000 available credit to you. And maybe really you're only using one. And that one is the one you owe $4,900 on. If the rest of them have zero balances. As long as they're open, it looks like you have very minor utilization. The percentage that makes you look good. But if you close those 4 that you haven't been using, the one account that's open now says you're maxed out.
I mean, but how does it look? How does it look like? Like they're like, here's your new credit card, renew it, but you don't activate it. Is the account?
Oh, then I don't know. Then it would. Well, they'd be calling you, letting you know what's wrong. They want to make sure you got it. If you get stolen or lost in the mail or something like that. So they eventually would send another letter, or they'd be trying to get you on the phone, and that would be then your opportunity to say, no, I've decided that I just don't want to do business. And then they would list it that it was closed at your request. Okay, and that would be the way to do it. You just don't want to go in and close 4 or 5 at one time and make the one you kept open, make it look like you're maxed out then. Yes,
How you can call, go back and say, yeah, I lost my job, just like,
Mhm.
Can you do that for, like, say you have a death in the family and you put all the funeral expenses on a credit card, can you call them and say, hey, look, this is what happened?
You have to call the credit card company, not the credit reporting agency. And you can file something, but with the credit card company, you have to let them know, because if it got to the point where you were going to be late making payments, or you couldn't make the minimum because you loaded it up, then you need to work out the arrangement kind of with them. Okay.
I was just gonna say also, like, if you know you're gonna make a big purchase and you don't wanna be maxed out, if you have like a good payment history with a company, you can just ask for a higher limit.
Exactly.
And it doesn't look like you're maxed out. You don't wanna go above 30%.
Yes. And that's exactly it. You've been to this, you've read on this before.
Yeah.
That's the other thing, because what can help your credit score go up a little bit, and this goes with the amount. So credit grantor companies and stuff, what can affect your score. In a perfect world, they would like you not to have more than 30% of your credit limit. But if you get up to 50%, you're still okay. I mean, your score might be getting a little bit, not much. But once you start creeping up there and you're getting into 75, 80% of the credit limit, says that you're living on credit, that you're really above your means. And like I said, in recent times, they're looking for people who probably maybe have been out of work and they're just trying to survive.
I have a question about
student loans, because a lot of persons in this room has student loans, and it counts for your credit score. But when it begins to count badly, it's when they begin to get interested, like, or.
Well, as long as they're in deferment, it's not calculated at all in your credit score. It's there, it's listed on the file, but it's not used at all. Once it comes out of deferment and payments start becoming due, that's when it's utilized, because there's a notation and stuff like that. So then if you start, for any reason, missing payments and things like that, then it could bring your credit score down. So that's why we used to tell people, you need to make sure you know who's servicing your loans, because sometimes during school, they can be sold, they're moved around all different times and stuff like that. So you do need to follow up with that. And they do, most of them will work with you. They've got some kind of program, although, you know, for a lot of them, the interest will still be accruing if they, you know, that kind of stuff like that. So, but with all of the income-based repayment plans and, you know, things like that.
Yeah, I used to be a loan officer, and I remember some of my clients would have like a mortgage payment, pretty large payment, like over $1,000 a month. And then they'd have a lot of small credit card debt.
Yeah.
And then skip a mortgage payment to pay all their credit card debt. So they figured, I'm paying 5 accounts versus 1, but that just almost immediately disqualified them for a mortgage.
Exactly. Exactly.
So
You're right.
you have to be careful in terms of, like, you think you're gonna try to judge which ones to pay, which ones not to pay.
Exactly.
Always pay your mortgage first, I think.
Exactly, yes.
So as long as you're okay with the payments or current, you're fine with the credit score.
You're fine, yeah. Now, it is possible that you have paid everybody on time and you've never been late. It is possible to end up, keep accumulating so much debt that at some point in time, your score starts to go down, it's negative, because you're just so overextended. And what lenders do at that point in time, they pretty much, you know, they're waiting for it to happen. You're gonna eventually have to miss somebody. And that's a lot of times when people start calling us, because they said, I can't make next month's payments. I've struggled, I've done everything I can. I cannot do next month.
I have a friend who's also watching it online, and she asked that she was trying to buy a car, but they said that she has good credit, but it wasn't enough. And she said, is it because she only has one credit card? Like, is it?
That could be it, and it depends. Sometimes if she has one, it might be like with a clothing store, it might have a limit of like $250 or $300. A lot of times that may not be enough. They want to see a bit more of a track record, or at least have that credit card open for a longer period of time.
Is it better to have maybe like a variety of credit cards?
Yeah, as long as you, like I said, as long as you don't end up with a collection of them. But also too, sometimes people are a little impatient, and they've had an account and said, I had it for 3 months and I made all 3 payments on time. A lot of times credit bureaus want to see like a year or more, a little bit longer track record to see how you're doing.
Okay.
Yes.
So, let's say, right?
I feel you're working at angle.
So is it more favorable to not pay a car loan or a credit card?
Neither one's good, but a car loan would hurt you much worse in your credit score.
So if I paid off my car loan, and then I was like, I didn't have enough more to pay for my other credit cards, and they always deposit, does that look better than if?
Nah, it still looks bad.
Oh, man.
Still looks bad. The difference is, like I said, if you don't make the car loan, someone's looking to get it. So that you know, most times you may not have the opportunity not to make the second one, because somebody's already.
They gotta go through. And I'll come off the bat.
Credit scores are used to when they apply for credit, okay? But a lot of people aren't aware that it's used for employment purposes. So if you're applying, for instance, any place, city, state, federal government, they're pulling a credit report. If you're working some kind of a financial institution, banks, credit unions, brokerage firms, they're pulling credit reports. And a whole host of other places in between all in there. One of the things, in fact, I always mention, because we had this happen quite seriously, and the Baltimore Washington corridor, there's so many people that work for government agencies, so that even if you're not actually employed by the government agency, but you're at a company who does business and they're under government contract, like Johns Hopkins Applied Physics Lab or Northrop Grumman and stuff like that, most of their people also have to have credit reports pulled, because many of them fall under the government contract. If you have to have a security clearance, if if you have a bad credit score, bad credit report, you're not getting a clearance. And if you had the job first, you got the clearance, if their government will pull, right now, they're pulling it twice a year now. And it's a soft inquiry, so it won't affect your credit score. But they're reviewing it seriously, and if your score goes down, your credit goes delinquent, they'll give you 6 months to clear it up, or they pull your security clearance. So they're really serious, and one of the reasons why they're paying so much attention to it right now, kind of like the rest of the world here, it's the graying population. They're facing people retiring at massive rates at points in time right now, because 10,000 people a day are turning 65 in this country. Most of the world, because of World War II, the baby boomers, but that's the rate. It started in 2011, it's going to go for 18 years. So it's that many people leaving the workforce as they can, and they're trying to make sure that they have enough people to do the job and have the security clearances so it doesn't shut down the government. So they're instituting some programs where it's kind of like job sharing and stuff, so they don't have just institutional knowledge, just, like a desert. Also, like I said, for housing. So most people know with apartment complexes and stuff or a mortgage that they're going to pull a credit report. But anymore, individual landlords will require you to get a copy of your credit report. Go to annualreports.com, give me a copy of the report. Because in many cases, if they have a tenant in a property that doesn't pay them the rent on time, they can't make the mortgage payment on time. So you're jeopardizing them losing a home and a source of income for them. So that's why I said they're doing that. Also for insurance purposes. Statistically, people who have poor credit payment habits, poor credit score, file more claims. So they can decide whether or not they're going to insure you. And that's home, auto, life, or they'll set the rate. So even if they do insure you, it may be paying a much higher rate. Now the FICO score, this is some of the stuff that it doesn't include, because again, if it's not on the credit report, it can't be used. So it pays no attention to race, color, religion, national origin, marital status, because everybody has their own separate credit report. The age is on your credit file, but it's not used. That's really used just as an identifier. So it doesn't have you and a 50-year-old mixed up. Yes, sir.
Quick question on me. If, let's say, a single credit card, and then you have, the primary owner of the card, of the line, and you have a secondary one.
Right.
How does this credit score work with that?
It depends on how the account was set up. If it's a joint account, when it's a joint account, means both parties are equally responsible for the account, and it's on both of their credit reports. There is also a situation where you can have, and it's usually husband and wife, where they'll have one set up as the owner of the account, and the other one as an authorized user. Anytime there's an authorized user, that person is not liable for any of the payments at all. And if you're an authorized user, it's designated on your credit report as such, and that's not used to calculate the credit score.
It's not.
No, because you're not responsible for the payment. A lot of times, parents will set kids up, 16-year-olds and stuff. They get them an account, they go, okay, well, at least get them a credit report started. It doesn't really build them a history, but at least gets them started with the accurate information, correct spelling of the names and birth dates and socials and things like that.
So what you're saying is that if it's a joint account, it's equally, so everybody has their personal scores anyway.
Right.
That's what you're saying?
Yes, there's no household file. So John Smith and Mary Smith each have their own separate files. And what could be different, now some people, they already have, everything's exactly the same, everything's joint. They've got the mortgage, they have the same credit cards, so their credit reports would be same score, same information. But in many cases, you'll have, John Smith has his file and Mary, and they both have the same mortgage on the file, they have the same car loan, maybe the Bank of America MasterCard, but he might have an Amex and she might have, I don't know, Macy's, or so it could be different. Okay? Now, when you're going for a mortgage, they're looking at the two and combining it, so I was terrified of this stuff. If you're getting serious about anyone to the point of, living together or going to put joint accounts, joint bank accounts there, you need to be sharing credit reports. Same thing, especially if you're going into marriage, you don't want to be going in with somebody. If you're a saver, you're responsible, and someone else gets, they don't pay anybody because you're going to be dragged down with them. Okay, and then same thing. I also say this in terms when it comes to student loans. You know how much you owe in student loans, how much do they owe? You might be 75 for you to buy a house with the amount of debt or something that you're carrying. So you do need to discuss all that when you're getting into a living situation.
So my friend online, this is probably from some time back, But she asked, what does the word pre-approved mean?
Pre-approved is basically kind of refers to that soft inquiry. That's when a credit card company, usually it's credit card, they're trying to add to their portfolio of accounts. So what they have done, they have gone to the credit reporting agency and they said, we want to add on 10 million new accounts. And they give a list itemized of characteristic attributes that they consider the perfect customer. Somebody that's, had a credit file established at least 10 years, I'm gonna have it with 5 other accounts open, never been delinquent, no public records, a credit limit of maybe at least one account that has $10,000, that kind of stuff. The credit reporting agency then goes into their database and data mines it out. They give a list of things, not to the credit grantor, but they send it to a third-party mail house, because we're not allowed to turn it to them directly. That mail house then will go ahead and apply some other criteria, maybe like score ranges or how many they need per state. Okay, maybe they're expanding. A retailer will do it like when they're trying to open up a new store. They'll do like an 8-mile radius around a new Kohl's store, something like that. They'll solicit all the available households. So they send that offer in the mail to you. You've been pre-approved for a $5,000 credit limit. Once it's pre-approved, they have to make you a bona fide offer of credit. The only way they can turn you down would be is once you respond to them, they'll usually pull another credit report, is if they find, maybe since the time the credit report was reviewed, and they maybe you filed bankruptcy. There's certain guidelines that they could turn you down. Otherwise, they have to give you their credit card, which is different than an invitation to apply. An invitation to apply is what somebody's just mailing out mass mailers, and they're asking you to fill out a whole little mini application kind of thing. In that case, they have not reviewed your credit report. They're just inviting you to apply, and they usually turn down as many people as at least 50% they turn down.
Excuse me,
we're
going to have to stop the questions. I'm so sorry.
I'm going to be around.
Because of the time, we're going to have to stop the questions. But our speaker has graciously agreed to continue on in small groups. So we will sort of adjourn this formal part, and then she will stay, and you can talk with her and gather in small groups, get leftover cookies, etc. But we have to stop the formal part of the seminar. So I'd like to make sure that we thank her. Please fill out your evaluations, but please, everyone, give a hand. You are wonderful. Thank you so very, very much.
And this is always the topic that gets a lot of